Good afternoon and welcome to our post-report webinar. I'm Arlan Suderman, Chief Commodities Economist at INTL FC Stone. And we're going to take a look today at USDA's quarterly grain stocks and small grain summary report, talk about the implications of some of those numbers, and then take your questions at the end. So if you have questions along the way, be sure to go ahead and enter them on your screen, and Jake will read them off to me at the end of the presentation. So let's go forward. First of all, before we get into the numbers, we ran a survey. Granted, it was a Twitter survey, so that's nothing official here, nothing scientific about this, but just simply reflecting the opinions of people on Twitter. And I wanted to know what their view of the grain markets are as far as prices now versus a month ago. Are they more bullish now after the crops have matured another month, or are they more bearish? And it was interesting to see, and I wanted to show these before we really get into today's numbers because it does have some implications for the markets in today's numbers. And overall, we find that the participants in the survey were a little bit more bearish on corn than they were a month ago. That may have changed a little bit after today's report, but I don't think in the end today's report changed that much fundamentally. Somewhat it did, and we'll talk about that. Soybeans is a little bit more bullish on soybeans than they were a month ago. You know, the survey doesn't say if that's because they felt like the soybeans are going to yield a little bit less or because they've seen the strong demand. It just reflects what the current sentiment is versus what it was a month ago. And on wheat, it was a little more friendly as well. And I think that is reflective in the charts. And here again, it's probably more reflective of what we've seen of late. People starting to feel a little bit better, like maybe wheat put it in a bottom. But here again, today's results may have changed those attitudes. So we'll talk about that. Now, price is still a function of supply and demand as modified by the flow of money. So what's the flow of money doing? We're seeing the dollar had continued to break lower, broke down to around the 91 cent level, so to speak, the dollar index, and has rallied this week. Now, pulled back a little bit today, but we were on pace coming into today to be the strongest one-week gains that we've seen all year long. So strong performance of the dollar this week, pulling back a little bit ahead of the weekend, and a little bit of profit taking. Some of that strength this week, in fact, much of it was due to the euro, a weakness in the euro following the last weekend's disappointing election results in Germany, kind of highlighting the problems in the Eurozone at large. And some of it was due to a little bit more bullish, or hawkish, I should say, outlook toward the dollar and Fed policy following the Federal Reserve's latest meeting and comments made by Fed members, including Janet Yellen when she spoke this week. Excuse me. So dollar gaining, euro falling. The question is this a correction? I mean, it's been a big drop of over 10% this year. Or is this a turn in direction? Have we hit a seasonal low, so to speak? Time will tell on that, but that has implications for the commodities. As we look at the weekly chart for the CRB over the same period, and I want to draw attention once again. I've indicated in the past that here we have the 2006 low for the CRB, which is a basket of all these commodities. Notice that they're weighted differently. Crude oil is 23% of it. Energy sector makes up 39% of it. But we put in a multi-year low, a long-term low in 2016. The low in late June 2017, which included a bullish island reversal on the daily charts. This is a weekly chart again. That low came in above the 2016 low, and this is fairly typical. The market not going straight up when it puts in a bottom, but slowly gaining momentum, higher lows, higher highs. And we're working our way up, and we broke through some resistance here a month ago, and we're starting to work our way higher, consolidating a little bit now. The continuous commodity index is more designed to be equally weighted among the commodities that are in it. And as a result, energy, which has had a strong month, doesn't have quite the impact on it that we see in the CRB. but we see similar dynamics there, just not to the same rate of gains. Crude oil, I want to draw attention to this. And this is the Brent crude oil. This is traded off of North Sea crude oil and is more the contract that the rest of the world uses. And look at this high here. Highest level that we've seen since 2015 here. Now we have pulled back some here late this week. And that pullback came after a failure to take out the $60 level. So far we haven't done any damage to the charts. WTI is not quite that strong. In fact, the WTI is trading about $6 below where the Brent is. That's where it was when last I got time to check before putting together this webinar. And part of that's because of the hurricane. Much of it, in fact, is due to the Hurricane Harvey taking out capacity in our refineries. So we built up supplies of crude oil. We tightened up supplies of product. Because of the buildup in supplies, we saw WTI lose ground to Brent, and that actually made the WTI more competitive on the world market. We started exporting it. So the WTI has gained a little bit of upward momentum too. It did put in a bearish reversal yesterday. Last I checked, it was holding yesterday's lows, so we'll have to watch that. But crude oil has a big impact on the CRB, particularly WTI. Now, this is something I haven't shown to you before. This is one of the ways we follow statistical correlations. And here again, let me say that a correlation of 1-to-1 means that as A goes up, B goes up by the same amount. Or a -1 would be as A goes up, B goes down by the same amount. And we generally see a pretty good correlation between the CRB and WTI crude oil. And for example, notice here in this chart, the 100-day, this is about a 6-month moving average here, pretty consistently going back and forth either side of a 0.9. We figure any type of a correlation above a 0.7 or a -0.7 is pretty significant. And it says, take note, that's a pretty strong correlation. So the correlation here between WTI and crude oil is pretty strong, which is understandable, since WTI makes up 23% of the CRB. Now, you can see here, and this is the last 200 days here we basically have graphed out, that the 30-day moving average really dropped down last spring, I should say. So did the 10-day even more. And then we broke lower here late summer. But other than that, we've pretty consistently through the spring and summer traded a strong correlation. Now on the corn, we see a little bit different, much weaker correlation here between the CRB and corn. So soybeans is where the strength is. Now soybeans does tend to be a little more of a leader of the grain complex, so that's good. But the correlation isn't quite as good for corn and wheat. In fact, it's been rather weak at times this summer, strengthening more of late. And you look at the 6-month correlation, it's actually near zero here, so on the corn. On looking at soybeans, I mentioned the 6-month correlation is running right here at, looks like about 76 or 70, yeah, about 74, 76, somewhere in that. Pretty good correlation between the CRB index and soybeans. You'll hear me talk about that a lot. Really weaker earlier in the year, and so we're making up for that, and we're starting to trend better with our correlations. That's something I've really noticed over much of September until this week. You'll notice the 10 days really dropped this week and started to come back yesterday or today. And then wheat, you see very similar to corn, some very weak correlations. In fact, even some negative correlations in here, which doesn't make logic sense. That just says that wheat has some of its own dynamics right now, being very oversupplied. This is a Chicago soft red winter wheat contract. Kansas City is similar. But I'll add room on here for one on this slide. I wanted to show you these correlations, and I'll bring them back from time to time, just to show you what I'm talking about. Looking at today's numbers, first of all, first number we see here is this number for wheat, September 1st wheat number. That came in 48 million bushels above the average trade estimate, and looks like 43 million bushels above where we were a year ago, and even more above where I expected it to be in this first quarter. Now, it's a little bit of a high risk trying to estimate wheat stocks in this first quarter. I say first quarter because the wheat marketing year starts June 1. Because the big question is how much wheat feeding was done in the first quarter. And so that's the big, because that's when the bulk of the wheat feeding was done. I obviously overestimated, and I thought I was being conservative on wheat feeding. And in fact, as I calculated out, based on this number, wheat feeding, instead of the 150 million bushels that USDA has been forecasting, is probably closer to 95 million bushels. So a dramatic drop in wheat feeding this year if these numbers are correct. Keep in mind that we do get some volatility in here, and in the next quarters we'll have some big negative numbers in the residual use of wheat. So this is one of the challenges of estimating winter wheat stocks from quarter to quarter. Now, when we look at the corn number, 2.295 billion bushels, that's 58 million bushels less than the trade expected, and even more again than what I had anticipated. And some of that can be from actual exports being a little bit different than USDA says. Not everything is inspected, so we can be actually shipping more wheat than what corn than what is reported each week, because some corn, particularly any corn that's donated or in anything under NAFTA, does not need to be exported, and those exports are counted by the census numbers, are in the census numbers, but those are delayed by 6 to 8 weeks oftentimes. So the more likely assumption here that will be made is that feed usage in the fourth quarter of the last marketing year was larger. Now that would put a pretty large feed usage number on there for the fourth quarter. It'd be one of the largest quarters we've seen for the last 10 or 12 years for the fourth quarter. So yes, livestock numbers are up, but still seems a little bit high. But keep in mind, when USDA is doing these stocks numbers and the statistical models that they follow, or measurements that they follow, just a small fraction of a percentage of being off from survey error can throw you off this much. So we'll see after the second quarter if we still see this amount of consistency. But nonetheless, I made some adjustments in my balance sheet, and I'll talk about those coming up. This now becomes the final ending stocks number for the 2016-17 marketing year. And so I'll make those adjustments to the balance sheet and what I think USDA will do in our October 12th crop report at the end of the presentation. Soybeans. Soybeans at 301 million bushels. This just kind of keeps in live now the trade understanding that USDA has this tendency to overstate soybean ending stocks, and by the end of the marketing year they're usually much lower than what USDA had been forecasting even just a few months ago. Just a few months ago, USDA was forecasting 480 million bushels of old crop soybean ending stocks. So no wonder we've got our people out there, our fund managers in some cases, who are saying, and certainly farmers, well, if USDA is talking about a 475 million bushel ending stocks for the new marketing year, surely we're going to end up tightening that as well. Well, maybe or maybe not, and we'll look at some of those pieces as we go forward. USDA did take 11 million bushels off of last year's crop, so they adjusted. It's not all that much, but they occasionally will do that after this September report. Now, these numbers, since usage for soybeans is primarily crush, which is measured, and exports, which are measured. And so it's a little bit surprising to be off that much yet. This implies an increase of 34 million bushels in residual use. What's residual use? Residual use is, they don't know, it's just disappearance. So some of that may show up in the census soybean exports. We'll find out maybe we were shipping more than what USDA said in their inspections. Some of it will simply go down as residual. And some of it maybe USDA still is too high on its 2016 report, but it'll probably end up, the crush will go up a little bit, but I think the crush will end up very close to where I have it. And I'll show you those numbers. Well, I guess I don't show you the details of that, but a few million bushels from where USDA is at. Some of it go in the export, some of it in residual. More surprises into wheat. Now, overall, the trade and myself were looking for a reduction in the size of the wheat crop at 1.718 billion bushels. I was looking for 1.715, very close, came in at 1.741 billion. All winter wheat came in at 1.269 billion versus trade looking for 1.286, and I was looking for 1.287. Hard red winter wheat dropped to 750 million bushels. The trade is looking for 658. I was looking, 758. I was looking for 759. Soft red winter, here again a surprise reduction, 292 million bushels. The trade was at 305 and I was at 306. An increase in white winter wheat. Hard red spring, though, this is where the big surprise was. USDA increased its planted wheat acreage numbers and cut harvested acres, but I don't think they cut it enough. But having said that, these are the numbers. These is what will be traded. Durum, I also expected abandonment or reduction in harvested acres there to reduce the size of the crop, and as did the trade, although I was looking for a little bit more, and instead we got bigger. So this will be something interesting. I have here planted acreage now was adjusted upward to 11.009 million acres. Harvested at 10.159 million. That's pretty good size abandonment, but based on what the data we were bringing in, we expected it to even be a little bit larger abandonment than that as well. So let's take a look here. And this is looking at winter wheat production changes from USDA's last estimate, which is in August, into their final number. And this is to be their final number. Occasionally they will make additional adjustments in January. We came down 18 million bushels for the winter wheat crop since August, and that is fairly typical for what we see over this period of time over the last 20 plus years. Now in spring wheat, it went up 2.7 million, and they went down in harvested acres, so there's some assumption that they'd come up some, but that's a pretty good increase. A little bit of a surprise. As we look at where that abandonment came, this is the implied abandonment based on USDA numbers released today. 31% abandonment in South Dakota. One of the surprises to me, I would have expected Montana to have had higher abandonment, maybe a little bit higher in North Dakota as well in some of the western areas, although that is a little bit more in the Durham, but I did expect a little bit more in Durham as well. So you see the numbers. Not surprised by Minnesota. They had a good crop overall. Not surprised with most of the others. Abandonment at 7.7%, excuse me, for the United States as a whole for the spring wheat. Now, having looked at that, excuse me, we see here the chart for winter wheat acres. The blue is for the planted, and the red is for the harvested, so the difference would generally be considered abandonment. We see the winter wheat yield coming in above trend this year. No surprise there, well off of last year's unbelievable crop, but still above trend. Other spring wheat, and here we see the gap, which is the larger abandonment than what we've seen over much of the last 10 years. Other spring wheat yield down to 41 bushels per acre. Kind of at the extreme of what we typically see in variability versus trend. Oops, there we go. Now, let's look forward at the weather, and then we'll kind of pull these all together. Weather forecast now is focused on Southern Hemisphere and primarily on South America. And I put this graphic from Commodity Weather Group on here so you could see the kind of, first of all, the composites of the analog years. And here again, the primary producing areas of Argentina are in this area, and Brazil would be in this area. I guess I need to put my pointer on Argentina in here, and Brazil largely in here. And here's precipitation and temperature. And here's last year's as well. Here's Commodity Weather Group's forecast for the summer growing season, which would be December through February. This is for the rainfall, and this is for temperature. And down here in this corner, we see some of the areas that Commodity Weather Group is really paying attention to see surface temperatures. And right in here, we see the Nino 3.4 area, which is a measurement of the ENSO cycle, or has strength of La Nina now that we're looking like going into versus the El Nino. But looking at other areas of the Pacific Atlantic as well. You put it together at the analog years, and the thing that really stands out to me is southern half of Brazil's growing season has 59% odds of being too dry. Now, it can be somewhat too dry if there's no heat and still get decent yields, and the odds of heat are still relatively low, although 2% higher than normal. Also somewhat concerned about Argentina's growing season as well. Right now, parts of Argentina are simply too wet, although we are seeing a little bit of a tendency toward improving it. Overall, we're looking at the really, really wet areas at about 10 to 15% of the belt. Another 25% of the belt is abnormally wet, a nuisance wet, creating some problems. So we could see some wheat quality problems, and we could see some loss of corn planting. As we look at the forecast going forward, the 1 to 5 day forecast has good rains in some of these dry areas of Mato Grosso and Mato Grosso do Sul and much of the growing season area here. Still some rains in some of those wet areas of Argentina in the next 5 days. Argentina really dries out in the 6 to 10 day. Rains come back again in 11 to 15 day, but look at how much of central and northern Brazil belt dry out in the 6 to 15 day. Here in the United States, we're going to have probably some harvest delays here in the western Midwest and into the central. They move through a little bit quicker in 11-15 in the east. So if there are some concerns, they're going to be in the central western areas. No real problems anticipated at this point though, but we'll monitor it. Okay, so incorporating today's corn stocks numbers into my balance sheet, and I said probably a little higher feed usage, probably a little higher exports. That now translates into patterns for the 2017-18 marketing year, which started September 1. The first scenario that I have on the left is with a yield of 166.9 on 90.886 million acres. The yield is what showed up in our September 1 client survey. USDA, of course, is closer to 170. The acreage is what USDA has been going off of. The FSA acreage suggests that that acreage number may creep a little bit higher, maybe 250,000 bushel acres higher, maybe 300,000. We may see part of that in the October crop report. But for this purpose, I'm sticking with the 166.9 and the 90.9 million acres, and I get ending stocks at just over 2 billion bushels of the marketing year average cash price. 358, very similar to this year. If in fact, and the harvest results for the most part have been better than expected, less than last year, better than expected, in most cases better than APH than what I'm seeing, that would suggest the possibility, and here again, I went by those FSA acres and I bumped us. I bumped our acreage, and I didn't bump it all that much here. If you look at the FSA acres numbers, it suggests that we could be up 1 million to 1.25 million acres. I went up, what, 300,000? Oh, I'm sorry, this is corn. It's soybeans can be up that high. Corn, I'm sorry, I gave some of you a heart attack. Corn could be up 300,000 acres, maybe 250,000, 300,000. So I bumped the yield, I bumped the acreage. I wanted to give a bearish scenario, and it still leaves ending stocks at 2.309. While we're ending stocks for the old crop year, 2.295, very similar, very close, but a marketing year average price of 327 just because of erosion of cash values. On the other hand, what would a bullish scenario be? Well, a bullish scenario at this point would be if the corn crop does, as we get into later harvested corn, the later planted corn, the yields start falling off. We see the national average drop off to 165, and we stay with the 90.9 million acres. That drops ending stocks down to 1.8 billion bushels and justifies a marketing year average cash price of 382. Nothing bullish, but it is less bearish than what we saw this last year, and I do think we'd see some price appreciation since the funds are looking more favorable toward the broader commodity sector, as I showed you at the beginning. On the soybean side, we did see this improve with the lower old crop ending stocks. That means lower new crop beginning stocks, and using our yield from our survey of 49.8 and the harvest results so far would seem to confirm that against what I thought they would. They've come in much better than what I anticipated. And so if you plug that in plus today's numbers in the stocks, it would suggest ending stocks of around 443 million bushels and a marketing year average cash price of $9.35. So it bumped it up just a little bit. If, on the other hand, this crop keeps getting better and we push that yield up to 51, up a little over a bushel from where we're at now, and we do add up to 1.3 million acres, which is possible, probably won't be quite that much, but it is possible, we could see ending stocks at 641 million, quite ample. Now, this is better than over 700 million we were talking about here not long ago, so we are getting better and pulling it down. But even this, it's over 600 million, we'd be looking at a marketing year average cash price of 845. If, on the other hand, we don't raise the acres, which is unlikely, but let's say we don't, and we stay with that 47.8 bushels per acre, that is basically what our models are saying right now. Those models have a pretty good track record, then that would suggest ending stocks at 281 million bushels. Well, 281 would justify a cash marketing year average cash price of 1065. Well over where we are now. Futures would probably spike well over $11 into this scenario. So it's something to pay attention to. On to wheat, we basically on our old crop pulled feed usage down, excuse me, not old crop, we're talking new crop for wheat now, to 95 million bushels, adjusted exports a little bit from where we were. We get ending stocks at 949 million. That's compared to USDA's last WASDE report at 933 million. If those exports, which I'm a little bit more optimistic in USDA, but let's say I'm wrong and they came in a little bit weaker even than the USDA, we could quickly be back above 1 billion bushels. The wheat that has the most problems with big stocks is soft red winter, followed by hard red winter. Tightest is white wheat in Durham, and you can see here the disparity really shows up. So, take-home points. Today's stock numbers confirm ample corn and wheat supplies, more bearish wheat than corn. Corn would suggest that we're slowly getting better, and the fund managers like that. Soybean numbers do reinforce USDA's tendency to overstate supplies and understate demand. The market will be expecting that to happen again this year as well. I think USDA currently has a much more aggressive export target in its balance sheet than normal, so I wouldn't expect the same degree of reduction of ending stocks over time, but I think there will be some. Big soybean crop is now essential with these demand numbers that we see, but thus far it would suggest that we do have a big enough crop to carry. Finally, remember the money. Fund money sets the tone, and the funds will look at these fundamentals differently if they're friendly to commodities than if they're bearish to commodities, as they've been the last couple of years. And right now I see them as a little bit more friendly to commodities. So with that, less numbers in these quarterly reports, so we're done a little bit sooner. I will turn it over to Jake for any questions that he might have that may have come in.
We don't have anything yet, but we'll just give it a minute or so.
Okay, sounds good. Gives me a second to rest my voice a little bit. So be sure to put your questions in. We always appreciate and value those questions as they come in. And we'd also like to hear your feedback on, we made an investment here in upgrading our equipment, and let us know what you think of, are we hitting your standards on our webinars? We hope so, and we want to meet a need with it. Any questions out there? We'll give you just a little bit longer. This was a report with not that many numbers compared to our regular WASD reports, so it wouldn't surprise me if we didn't have any questions come in. Not that many points to discuss beyond what we've covered already, so we'll give it just a little bit more time, and then if not, we'll go ahead and close it out until our October 12th webinar following USDA crop report on that day.
Hey, Arlan, we got a question from Greg.
Okay.
What is your early call on planted winter wheat?
Excellent question, Greg. We're going to be surveying our clients again here in another couple of weeks, but this is what we've been seeing. Our last survey in August showed about a 12% drop, and that was pretty much, it varied from state to state, region to region, but it was fairly well across the board for soft red winter wheat, hard red winter wheat, and hard red spring wheat as well. We have since seen things change a little bit, and at the time I felt like 12% probably would come down. We'd probably end up at 6 to 8%. With the amount of rain that we are currently getting in the Plains hard red winter wheat belt, I think that number is going to go up. And also we have some problems with fungal diseases in creating some toxins in the feed grains in the high plains. And so some farmers who had gone away from wheat toward the feed grains are coming back to wheat. We'll have some areas in the high plains that will probably increase their acreage. Then we'll have a lot of places in the plains who will plant more wheat and with the expectation to simply graze it off, or it'll be a cover crop. So I think that we're probably going to be down overall 5 to 6%. The next question is how much of that will be harvested, particularly if we're higher than that. But that's where I'd have to say we're at right now.
Greg, as a follow-up to that, where are you adding 1.3 million harvested soybean crop acres? Double crop?
I can't remember the state-by-state numbers right now, but basically going through the FSA numbers, and the latest FSA numbers we have, of course, is from September 12th, the last date they released, and just looking at the typical pattern, not all the farmer certified acres are in yet, so there will be some adjustments. But looking at it from a total standpoint versus what we normally have in September and where final acres tend to be, looking at that. But I don't have a state-by-state breakdown with me, Greg.
We have another question from William. With the smaller ending stocks than expected, do you see storage pressure decreasing?
Oh, good question. Smaller ending stocks, does that decrease storage pressure? Yes, a small amount. That'll be more regionally. Depends on where you're at. I'm already seeing corn piled on the ground in some parts of the Midwest. Now, in some cases, they're piling the old crop corn they still have on the ground to make room for a new crop. But this does ease that pressure. The smaller winter wheat bushels, and the smaller soybeans, I think we particularly have eased that load in the plains. But there's going to be some areas in the Midwest who still have some problems.
We have a question from John. Any thoughts on hogs and pigs report, grain-consuming animal units going forward?
Hogs and pigs report pretty much as expected, but the differences were more of the heavier weight hogs, fewer of the lighter weight hogs. So that's why we saw the spreading in the futures. With today, the board was up, overall neutral to slightly supportive. the nearby contracts weren't up as much as the deferreds, at least the last I looked at it. Animal units are continuing to increase. We're increasing cattle on feed as well. You cannot correlate this nearly as strongly as we've tried to do this as what we could at one time. Since the advent of ethanol and DDGs, that has displaced corn and changed those feed dynamics. So I still think USDA is a little bit too high in their feed usage estimates, but overall that is where we're getting it from, is from the increase in the 2.5% increase in market hogs, heavier on the heavier weights and lighter on the lights, and that's fairly consistent with what we're seeing, I think. So cattle moving higher as well. Numbers slip me now, I can't tell you. And poultry going higher.
That appears to be all the questions we have, Arlan.
All right, thank you much, Jake, and I thank everybody for being here once again today. And there again, you see my Twitter handle. You can get on Twitter and shoot me a question if you like. If you think of something, direct message me. And we'll be back with you. It's Thursday, I believe, October the 12th, after USDA crop report, where USDA will incorporate these numbers, update their production numbers, and we'll see where they come out on ending stocks. Look forward to seeing you then. Thank you.